Hey traders, Bearable Trading here. Just going to do this quick video update, final one of 2021, just to sort of finish off this little trade series that we've had going for the last couple of days. And there's a couple of things I want to cover off here. Firstly, apologies for any sound issues. I still haven't replaced the mic. Secondly, as always, this is purely for entertainment and education. Nothing here is financial advice. Any decisions you make based on what you see or hear is purely taken at your own risk. Now, there's a couple of things I want to cover off here as we look at the market. There are certain phrases and terminologies that seem to have become entrenched in trading law, and to be honest, for want of a better word, I think some of these are complete garbage. Examples of that would be phrases like overbought, oversold, you'll never go broke, taking a profit is rubbish, a paper loss isn't a real loss is rubbish. And one of the other things that people seem to, in my view, misunderstand is risk and reward. You know, quite often you'll hear the generic, oh, you must only take trades if they have 3-to-1 risk reward or 2-to-1 or whatever. But basing your sort of trading actions on a mythical number that you hope to get is false in my view. Now, when I enter a trade, I might have an area or a zone where I think the market may move to, which is fine, but the only thing you can control is your risk. So you have a defined risk when you enter the trade, but the market, as soon as you've entered the trade, pulled the trigger, every tick, the market is dynamic. Something may happen on the immediate next tick that your zone that you were anticipating the market going to suddenly is not in play anymore. For example, you've entered a trade and the next tick multi-trillion-dollar hedge fund decides to go the opposite way. That's going to affect your position. There's some event happens around the world, whether it's a natural disaster or an assassination of a president or something happening that tick by tick will affect your position, and that doesn't negate your reason for entering the trade. All it's going to do is going to have some outcome as traders react or take different positions to what you have. That's going to have an outcome on your trade. So when I think of risk reward, the most important thing is to define your risk. Now, if we look, let's just take a look at the markets that I mentioned the other day. The Bitcoin trade got stopped out. This is the Litecoin trade that's still going, hasn't hit any targets. We didn't take the trade in Binance Coin. This would have been to sell, if you call it this open. Solana would have been to sell on the open of this candle, and the reason we didn't take those trades was based on my projections as to where I thought the market may head. It wasn't, for Solana trade, the risk reward was about 1.35. The Binance coin was about 1.7, and that in and of itself is not a reason not to take the trade. If you have a methodology that has a risk reward of 1-to-1, but it's right over thousands of trades 90% of the time, then fine, take the trade. The risk reward in and of itself is not a it's just a hypothetical number that you're anticipating before the trade. Risk reward is a measurement, or should be used as a measurement of two things. One, how successful your perceived edge is in your completed trades, and also how efficient you are in executing that edge. So if we let's have a look at Ethereum. We'll just blow this up. So the the entry on Ethereum was the open of this candle around about 4037, and this was the stop. So it's about a $90 per Ethereum stop, and the calculated target when entering this trade is based on obviously previous information, and I have a method for calculating a potential target, and that gave us a target of 35.55. So it's about, in terms of risk reward, that was about 5.5 to 1, but that's only a potential area of where I was anticipating the market could go. Okay, now as the market develops, i.e. this day, was obviously a big selling day, the following day was a big selling day. As the market develops, this target can change. So the initial target of 35.55 following this down move changed to 35.17. The following day it moved down slightly again to 35.12, and today's candle opened about half an hour or so ago, and the actual target has moved up slightly to 35.19. Now, how you manage the trade, some people will just take this entry, that's their stop, they have this initial target, and it's going to hit one or the other, and that's it. That's their plan, which is fine. You're just going to wait for either this to hit or that to hit, and you're not going to do anything in between. Another way of looking at it is, as the trade develops, like your targets may change, but also I haven't on here I haven't shown my actual full trade management as to how this stop may change. One thing I do say, I don't simply move the stop to break even just because it's break even. That's another fallacy in my view. People moving a stop to break even, and then they say, oh, I've got a risk-free trade. Well, moving it to break even just because that's your break even spot. The market doesn't care where your break even spot is. The market's going to do what it's going to do. You have to have, in my view, a reason to get in the trade, a reason to get out of the trade, and a reason, if you're going to move your stop, a reason to move it. Now, as I say, you don't have to. You can just let this hit one or the other. Or the danger of that type of approach is when this trade was entered, it has a risk reward of 5.4 to 1. As the market moved down over these 2 days, and then this third day here, it gets within $30 of the initial target. And so at this point, you've now got, this is now your open risk. You're at risk of this moving all the way back to here, for you're trying to get your reward, even though this trade, as you say, you might still be in the trade here, even though you haven't closed yet. You're actually in profit by this amount, and you're trying to get another $30 per coin out of it. And so your risk, this is now your risk, and this is your reward. So it's completely skewed. So as the trade moves in your favour, you can, move your stop accordingly. Now you may want to, if the trade gets, you might want to do a certain, if the trade moves 50% in your favour, you move your stop X%. That's one way of doing it. You might want to do a trailing stop on, counting back the high of the previous 2 bars, or something like that. These are just ideas. This is not what I specifically do. But it's just to sort of say that your risk. There's no absolutes in trading. You can, as I say, just leave it as a set and forget. And sometimes you're going to come very close to a target, and it's going to go all the way back and stop you out. If you're happy with that, and your metrics allow for that, and it still works in the long run, that still works for you. That's fine. The danger is people micromanaging a trade. It moves. Let's say this trade, the first day it moves here, so they move their stop to break even. The next day it comes back, tags their stop, they think, oh great, I'm out at break even, but then it goes on and hits their target the following day. So they've missed out on a potential 5x, or 5 times their initial risk, purely for the sake of moving the stop to break even to make them feel good. It's a psychological crutch, in my view, moving a stop to break even just because you want to get out of the trade at break even, worst case scenario. If you do that all too often, in my view, you will actually miss out on those bigger moves that actually make your trading plan and give you the overall expectancy over all of your completed trades. So that's just something to think about. Another couple of things, as I mentioned previously, NFTs. I'm planning on doing something. I like to set myself challenges at the start of each year. That might be something like turning $10,000 into $100,000 on cryptos. I've done that. I've taken those challenges before. I might do another one of those. But also I'm thinking of doing an NFT challenge, which is going to be quite exciting. I haven't sort of got the full rules as to what I'm going to do, as how I'm going to set it up, but it's going to be something that I'm looking at on NFTs. I mean, basically the premise was to start off with a small balance of Ethereum and turn that trading purely NFTs to buy a Bored Ape with it. If you haven't got a Bored Ape, they're trading around about just under 60 Ethereum at the moment. So that's that's something I'm thinking of doing as well for the new year. So we'll see how I'll put some final thoughts to that and see how we go. Obviously, variable trading is still the bread and butter day trading in the futures markets. I'm sort of, as I mentioned previously, that's it's getting harder in terms of time zones to do that at times, and so I do like to keep aside from challenges outside of trading and making money, if you like. Obviously, there's other personal challenges that I'm going to be setting myself as we get into the new year. But I'll leave it. That's it for trading for this year. Hope everyone has a great new year and we get set up for 2022. Good luck. Trade well.